Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. What I do on the show, I'm trying to help people with all the different areas that are financially related to your lives. And as it turns out, and I heard this week, every single thing that we do in life is tethered, was the term that I heard, tethered to finances. It's tethered to financial decisions. Do I go to the store? Can I go on vacation? Can I take time off? Do we buy tickets to the football game? Whatever it is. Do we go out to a movie? Everything is tethered, as it was said, to finances, which is interesting. And I want to share a couple questions, answers to questions I got this week. I've had some questions in different areas. So we're going to talk about drawdown rates in retirement. We're going to talk about some alternatives with IRAs. And let me start there. The issue with IRAs, we have a traditional world where we live in, and that traditional world that we live in, we're told to follow the rules and do things the way that they're originally prescribed. So what I mean by that is we have traditional IRAs, and that's a term, and a traditional IRA typically means we set aside in our working years out of our earned income a portion of our earnings, set it aside into an established IRA account, a traditional IRA account, and in return, we get a tax deduction on our income tax return for that year. That amount that we set aside into the IRA as an annual contribution or a one-time contribution is tax deductible. It does not count on our income for tax purposes. Now, when you contribute to an IRA, a traditional IRA, you're allowed to contribute up to $5,500 now. It used to be only $2,000 a year, so it keeps going up incrementally, but it's $5,500 now for 1 year. And if you're married or have a spouse, they can potentially do up to $5,500 also into their own IRA. It has to be out of earned income, so they have to have earned income. And if you're over age 50, you can do an additional $1,000, which is $6,500 total, deductible IRA, removing that income off the tax return. So that's a good deal. But when I say traditional IRA, everybody thinks, okay, we go to a financial institution, we go to our bank, or we go to our broker and say, what do we do? And they tell us what to do and we do it. It doesn't have to be that simple. There are some, let's say, manageable opportunities there. So let's say you're a real estate investor and you want to invest in real estate, and there are some strategies that real estate investors need to use that others of us don't. You know, if we have a regular job, a regular paycheck, we don't have to get fancy. We could just take $6,500, let's say, if we're over age 50, move it over into an IRA, and get the tax deduction for it and be in mutual funds or annuity IRAs or bank CD IRAs or whatever we choose. And everything that we're in grows tax deferred. It's not tax free, but it's tax deferred. And we're not allowed to touch that money the minute we start an IRA until we attain the age of 59 and a half without penalty. So be careful there. So let's talk about these real estate investors or someone who wants to invest specifically in other resources that you can't get from the banks or the financial institutions. And I get the question, is it possible to roll over my IRA that's in a financial institution into a self-directed IRA elsewhere that can be investing in other avenues? And it normally happens with real estate investors. Here's the problem that real estate investors find, especially, the people who are doing the real estate flipping. Here's the problem. When we buy investment real estate here and there, we're not considered a dealer if we do it part-time, buy a property here, maybe 5 years from now we'll buy another property, we fix it up, we hold it, we rent it out. Typically, we're not considered what the IRS says is a dealer. So when we sell that property 5 years later, we normally have to pay tax on any gains, but we pay tax at a capital gains rate because we just bought it with our own money. Well, the ones that are a little more either professional or active are buying properties, fixing them up, flipping them 6 months later, 3 months later, 9 months later. The problem with that they're having is they're considered sometimes a dealer in real estate, but so are these buy and hold real estate people who own a lot of real estate. Even though they're not ever selling them and they're holding them for rent, they might be considered dealers. So first, find out if you're that. But secondly, if you're doing all the real estate flipping, a lot of people are seeing articles or hearing off-the-cuff advice that says, do you know you can invest in that real estate through your IRA? So I want to help with that question. If you're buying real estate for investment purposes and your intent is to flip it, turn it over, let me take that example first. You actually will find that if you held that real estate for over 12 months, so you held it 12 months in a day or 13 months, you could conceivably be able to pay a lower capital gains tax rate, which is only 15% if you're in the 20% tax bracket, or 0% if you're in the 15% tax bracket. So this is big news here, but if you're in the business of selling real estate, you don't get to enjoy that benefit at all, because even if you're flipping real estate, not in an IRA, you're just doing it every 6 months, 3 months, 12 months, even 12 months, like I say, if you're in business, you have to pay ordinary income tax because the IRS sees that that's your job or your occupation. So they make you pay ordinary income tax on that income. So you have to be careful there. You also have to be careful of FICA, whether Social Security comes in and says, wait a minute, that's earned income. Where most of us, when we invest in investment real estate, the profits are considered unearned income or passive income. Well, if you're deemed to be a dealer, now that income's active income or earned income. Now we have FICA, Social Security, self-employment tax, and everything else to worry about. Maybe even workers' compensation if you have employees helping you on your crew. So be very, very careful here. But anyway, back to my question of, can I do this in any different way to help save on taxes? Well, there is a way that can conceptually work and does for some people. And what they're considering is, can we invest in investment properties, and I'm using real estate because that's most common, properties inside my IRA? Well, why would they want to do that? They're paying ordinary income tax when money comes out of an IRA, so what's the advantage? Well, the advantage for people doing that is, number one, they're doing this every 3 months or 6 months. So every time they flip a property, they're paying tax, but really they're investing the proceeds back into their next property. So if it was inside the IRA and they're investing inside the IRA, and then that all the money of the sale proceeds and the gains go back into the IRA unscathed by taxes, then isn't all the money still in there to go toward their next venture? Well, yes, that's the advantage that they're after, that they're not paying tax inside the IRA intermittently on every single transfer. So they're selling properties, not tax-free as they'll say they are, but tax-deferred along the way. So they're multiplying money faster, again, being unscathed by income taxes on every single transaction. Now, you call your financial institution, your bank, hey, I want one of those. You call your annuity IRAs or your mutual fund IRAs, hey, I want one of these. They have zero incentive to talk to you about these because You're taking the assets out of the bank or the financial institution. You have to get to probably one of these real estate investor groups or something who have tie-ins with specific special custodian IRAs that allow the self-directed IRA that's able to be invested in, let's say, real estate. You can have a self-directed IRA otherwise, and it'd still not be eligible for being able to invest in real estate because the custodian IRA or the custodial IRA, the custodian has to be approved. There are special rules for these types of IRAs. You're not allowed to invest in your own properties. It can be owned by the IRA, but not you. You can't live in it. It can't be a vacation property for you. There are loads of rules for that, and I'm not going over them in this show. But I am telling you that it is possible. You will not get good advice by most of the financial institutions because it's out of their area. But it exists. So for those of you, you need to follow the rules specifically, but it does exist where you can invest in real estate, in an IRA, a self-directed IRA, but only through a very few number of custodians. It's very risky. You have to be very aware of the rules. We don't get involved with it in our practice at all because we're a financial institution, so we don't have anything to do with it. But it's general, common information I thought I'd share with you on the show because I was asked the question, is it possible? And I thought I'd answer the question on the show as general information for you. Yes, it is possible if all the rules are followed correctly through the right institutions. All right, now I have another issue that's come up, and this issue has come up since the Great Recession, and I do agree it was the Great Recession, which was in 2008, and that issue is the drawdown rate. What is a safe drawdown rate? And my question is, what even is a drawdown rate? What's that word? What's that word mean? To me, I don't even like the use of the word. I don't like the sound of the word. So when I hear drawdown, I cringe to begin with. Drawdown to me means a mistake somewhere. It means either, when I think common sense drawdown, that means, okay, I'm drawing down my assets or I'm drawing from my assets. I even heard last week in another conference, drawdown in reference to how much funds could go down. And I thought, what are you using the word drawdown for any of these scenarios? So where we heard it in '08 and where it became prevalent, most of you listening and watching have probably never even heard the term. But listen, be careful with this. Where I started hearing it a lot was after 2008. And what I heard in context was safe drawdown rate, what we've used historically in the past, safe drawdown rate percentages are out the window. Financial advisors were using 4% as a safe drawdown rate for retirement years. Most advisors weren't using a drawdown rate. If they were using a drawdown rate, they were making a mistake in the beginning, and I'll tell you why. What I found out was retirement planners, I guess, were saying whatever your lump sum of assets were when you retired, and when you go to a financial advisor and you were asking them the question, what's a safe, how can I afford to retire? I guess some advisors were saying, well, let's see, you could safely draw 4% on your assets statistically and mathematically without running out of money before your life expectancy, or maybe without running out of money at all. And I'm thinking to myself, wait a minute. It depends on, if you have a 1% interest rate CD, how can it's depending on where your assets are and how they're positioned. How can you say a safe drawdown rate as a general rule? So here you are, a CD investor, let's say. You have all your money safe. You don't want any money in the markets. And the advisor says, well, yeah, you can afford to retire. A safe drawdown rate is 4%. So you're drawing 4% on your assets, but they're only making 1%. And you're paying tax on the 1%. So you only get 3/4 of 1%, and you're drawing 4% from your assets because the mathematical model said statistically That should be able to suffice and last you for the rest of your life. That makes no sense, folks. So I heard that, and then they're thinking, well, okay, no, market-oriented investments, mutual funds and things like that, safe drawdown rates, statistically based on the law of long-term average rates of return, statistically 4% should be a safe drawdown rate. Again, I think I don't like the term, I don't like the philosophy of drawdown rates being a guide for retirement planning. So here's what I'm going to share with you. If you ask the question, can I afford to retire? And you get an answer, 3% or 4% ought to be okay. That ought to be a safe rate of withdrawal. No, we have to open up the hood. We have to look at the engine of your retirement assets. You're right, we do have to sometimes look at the long-term rates of return, expected rates of return, and they can change, and I grant you that. But to draw from your assets is different than to take whatever the earnings are. Now, here's why everyone was starting to use the drawdown rates. And then it blew up in 2008 and 2009 because we had negative rates of return. So you, in retirement, we're still looking at, we still need to draw income from these assets because we couldn't have retired had we not been able to draw. Well, that's where the fallacy was. So then came the science of income planning in retirement. So I'm going to back up. When you ask the financial advisor, can I afford to retire? And they do the math and they say the drawdown rate, the safe drawdown rate is no more than 3%. Now it's changed. It's the new world. I need you to think about something. If you retire based on that information, that 3% of whatever your assets are can support your income now, and you're either 55 or 59 or 62 or 65 or 66, I'm here to tell you, you are probably making a mistake right off the bat. Guess what that mistake is? You're asking a question, but you're getting an answer based on one period in time. Can I afford to retire? The answer on the drawdown rate is giving you an answer. Yes, you can afford to retire if it's the answer now. So let's say 3%, you have $1 million, 3%, that's $30,000 income before taxes, and I won't take taxes into case here or into play. So $30,000, yes, that's enough to retire in addition to your Social Security. You say, okay, fine, good, because I want it out of that place. And I ask, wait a minute, how old are you? You say, well, I'm 62. I'm allowed to take early Social Security. I'm retiring. And I say, did you factor in that you or your spouse combined might live another 30 years? Did you factor in that inflation's still going whether you retire? Inflation didn't retire. Taxes didn't retire. Healthcare expenses didn't retire. It costs more in the later years of retirement for healthcare expenses than it costs in the early year of healthcare expenses. There might be long-term care needs there. There might be one of you needing to go into a nursing home and wiping out the assets potentially of the other spouse. There might be inflation at the rate of 3%, the very same rate of your so-called drawdown rate. And again, I don't like the term drawdown rate. Draw on assets, the rate of interest, taking interest only what it's earning, I don't know. But draw down rate of your assets, the minute you touch principal, you're talking danger. And the minute you ignore future inflation, you're talking danger. So drawing down your assets or this drawdown rate of 3%, yes, I can afford to retire. I only need $30,000 based on in addition to your Social Security. What happens if one of the spouses dies? Not if one of the spouses dies, when one of the spouses dies. We lose one of the Social Security checks. In addition, we're still stuck, if we're on this drawdown rate, at $30,000 a year on $1 million. So 10 years later, we're basically on fixed income if we're on that drawdown rate. And if we're taking more than the assets, now here's the issue. Is the so-called drawdown rate based on 3%, but the average expected annual rate of return would be 5%? If that works, the principal asset is still growing, and there might be your offset for inflation because your base is growing. But what if it's the reverse? And what if, especially through 8, 9, 10, 11, and 12, before the markets really had their strong recovery, you were drawing down, supposedly, because you retired in 2006, you're using a drawdown rate through those bad times. You've shrunken your assets, and they don't grow. Your so-called drawdown rate never grows for inflation. And you're on fixed income for the rest of your life, actually eating into your principal and drawing that down, having less to even recover if the markets recover. And then we get into personalities of, well, here you're in the drawdown rate, and it was a perfect scenario in 2006 and 7 before the market crisis hit. And the models still might work for you, which I'm cautioning you it probably won't, but it might work for you. And then you get to the case where in 2008 and 9 and 10, you're scared. You just watched your assets get cut in half. You're still doing a drawdown rate of 3 or 4% of the original value. And the question comes to play, should you even have been in the markets, those markets that may have worked out wonderfully for you had you stayed, but your personality might not allow you to stay through those difficult times. You just might be too scared that you just lost a third or a half of all your money and you can't afford to lose. It's your retirement assets, and you pull out and never participate in the recovery anyway. So, folks, I need you to take a longer view and a deeper view on retirement planning. Don't ask advisors, can I afford to retire? You've got to get to a certified financial planner, a comprehensive financial planner, not just a financial advisor who handles certain types of products, but someone who will dig deep through all the years of retirement planning. Folks, you need to do retirement planning. Don't plan to retirement. Plan through retirement and through the legacy of the assets to your children, and evaluate all the years through retirement, of which that might mean 30 years, almost as long as all of your working years. If you started working at 25 and you retire at 62, that's only 37 years you worked, and now you're expecting whatever you had in your nest egg to last you the next 30 years of uncertainty. All the uncertainty we've had in the last 30 years was unpredictable and unprecedented. Expect a lot more of it than even what we've had. Folks, plan through retirement, not to retirement. It's extremely complex, extremely complicated. I'll implore you again, do not try to do this yourself. Give our office a call. It takes years and years of experience and training to be able to analyze all these components to help you in a secure retirement and even project some of the things that have gone wrong for people in the past, and use that experience to help build a more solid retirement plan for yourselves. All right, folks, I'm out of time. Feel free to email me, contact me. We'll be glad to meet with any one of you, discuss your own individual circumstances. Again, we're out of time on all things financial. I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.